Ever wondered how a $750 million fund could reshape the multifamily real estate landscape in Canada? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. Today, we have some exciting news from Starlight Investments, which has launched an impressive $750 million investment fund aimed at acquiring purpose-built multifamily rental properties across Canada's largest urban markets. This ambitious initiative is set to make waves in the multifamily sector, especially considering the growing demand for rental properties in major cities. According to CoStar, the fund will be bolstered by a significant contribution from CIBC Investment Management, which is pitching in $415 million in equity. This partnership underscores the confidence that major financial institutions have in the strength and resilience of the Canadian multifamily market. With Starlight Investments' head office based in Toronto, this move further highlights the city's pivotal role in the Canadian real estate scene. Daniel Drimmer, the founder and chief executive officer of Starlight Investments, is leading this charge. Under his leadership, the company has consistently pushed the boundaries of what is possible in the real estate investment sphere. With this new fund, Starlight aims to capitalize on the increasing urbanization and the growing need for rental housing, a trend that is particularly pronounced in Canada's largest cities. This strategic move by Starlight Investments offers a promising outlook for investors looking to diversify their portfolios with stable and potentially lucrative multifamily assets. As urban centers continue to expand, the demand for well-managed rental properties is only set to increase, providing a solid foundation for long-term investment opportunities. It's an exciting time for multifamily real estate in Canada, and with initiatives like Starlight's fund, the future looks bright for investors and tenants alike. Stay tuned as we continue to explore the latest developments in the multifamily market and beyond. The Bank of Canada has once again cut its target overnight rate by a quarter percentage point, bringing it down to 2.25%. This move is expected to invigorate the commercial real estate market by making borrowing more affordable and potentially spurring more deals throughout Canada. This is the second time in less than 2 months that the central bank has reduced its benchmark lending rate, highlighting ongoing economic challenges and an inflation rate that is projected to hover around the 2% mark. In its announcement, the Bank of Canada cited the persistent effects of a trade conflict with the United States, which has caused structural damage to the economy and increased costs. This situation has limited the role that monetary policy can play in boosting demand. Nonetheless, the bank's governing council believes that the current policy rate is appropriate for maintaining inflation close to its target, while supporting the economy through this challenging period of structural adjustment. Real estate leaders across the country have welcomed this decision by the Bank of Canada. Mark Feeder, president of Avison Young Canada, expressed optimism, stating that the rate cut is the good news the market needs right now. He believes that lower interest rates will stimulate market activity, attracting investors who have been cautiously observing from the sidelines, while also boosting confidence among those who are already active in the market. Residential brokers have echoed this sentiment, with Don Kotick, president of Re/Max Canada, noting that the cut to 2.25% could enhance consumer confidence in Canada's housing market. Although inflation remains a concern, this decision might encourage more buyers to enter the market after a period of hesitation, signaling cautious optimism. This rate adjustment comes at a time when the U.S. Federal Reserve has also lowered its benchmark lending rate by a quarter percentage point. Meanwhile, Canada's economic landscape remains under pressure. The Consumer Price Index rose to 2.4% in September, up from 1.9% in August, yet the Bank of Canada proceeded with the rate cut to prioritize economic growth amid signs of softness. Despite the potential for lower borrowing costs to put additional pressure on an already strong demand in the real estate sector, the Bank of Canada remains committed to supporting growth. The central bank's report underscores that trade tensions are reshaping global relationships and dampening investment across many countries. Canada's economy saw a contraction of 1.6% in the second quarter, primarily due to a decline in exports and weak business investment amid increased uncertainty. While household spending has been robust, the bank warns that trade actions by the United States are severely affecting sectors such as autos, steel, aluminum, and lumber. Looking ahead, the Bank of Canada projects modest GDP growth of 1.2% in 2025, 1.1% in 2026, and 1.6% in 2027. Workforce conditions remain soft, with the unemployment rate at 7.1% in September and wage growth slowing. Employment gains in September came after 2 months of losses, and hiring continues to be weak in trade-sensitive sectors. In the latest news from the multifamily real estate sector, Marcus Millichap, a leading commercial real estate brokerage firm, has successfully arranged the sale and financing of an 80-unit multifamily property named Lakedale in Dallas, Texas. This property, located at 2921 Kendall Drive, offers a mix of studio, 1, 2, and 3-bedroom floor plans across 63,557 square feet. Built in 1974, Lakedale is situated on 2.57 acres near Interstate 35, a prime location in the thriving Bachman Lake submarket. Marcus Millichap Capital Corporation, a subsidiary of Marcus Millichap, secured the financing for this transaction. Bart Hoover, the senior managing director, highlighted that this was a rare opportunity to acquire a distressed property from a long-term owner who had been self-managing it for decades. The acquisition required a bridge loan to complete the purchase, showcasing the complexity and potential of the deal. Investment specialists Bart Hoover and Nick Fluellen from Marcus Millichap's Dallas office had the exclusive listing to market Lakedale on behalf of the seller, the Yilmaz Family Trust, and successfully procured the buyer, Evan Reifman. John Brixon, managing director in the firm's Dallas office, secured 3-year financing at 80% loan-to-value with a national bank. Brixon noted that, given the upside in the cash flows, we were able to secure high-leverage, non-recourse financing with a competitive rate. Marcus Millichap Inc. is renowned for its expertise in commercial real estate investment sales, financing, research, and advisory services, with a significant presence in both the United States and Canada. In 2024 alone, the company closed 7,836 transactions, achieving a remarkable sales volume of approximately $49.6 billion. With over 1,700 investment sales and financing professionals across more than 80 offices, Marcus Millichap continues to be a powerhouse in the real estate industry, providing invaluable services to buyers and sellers alike. This successful transaction in Dallas underscores the dynamic nature of the multifamily market, particularly in robust submarkets like Bachman Lake, where properties are operating in the low 90% occupancy range. Such deals highlight the potential for strategic investments in multifamily assets, a trend that is resonating strongly across North American markets. As we continue to monitor these developments, it's clear that the multifamily sector remains a vibrant and promising field for investors seeking to diversify their portfolios with stable and lucrative opportunities. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.